Steve?
Okay, let's toggle over to the real estate and market update part of the presentation. Matt Lombardi will be doing that. Matt has been with the NAR for over a decade, working very closely with all of the economic updates, agent education, the real estate community nationally. And so Matt is renowned in that way, and Matt is going to give us the real estate and market update. So Matt, welcome to the presentation.
Thank you for that kind introduction, Steve, and good morning to all the realtors as well as attorneys still on the Zoom. We appreciate you being here. Bob, thank you so much for that great legislative update. And Mark and John, I look forward to hearing your input on some of the things that we're going to talk about here. So I start off this presentation with what a year it's been with market consolidation, which you all have seen. NAR and the 1 year anniversary of the Sitzer-Burnett settlement, what's shaken out since that big landmark ruling, and some big changes impacting the real estate market that have come out in 2025 and of recent forms. First and foremost, market consolidation. I'll go through this quickly. This first one is actually over a year ago, but this was a big one locally with Compass acquiring at properties, sort of setting the stage for consolidation on the local front. On a national front, Rocket's acquisition of Redfin is really a game changer on a national scale. For those of you in the industry, this creates sort of the front end funnel for the lending side of Rocket's business. And then as soon as they announced the Redfin deal, they acquired their biggest competitor, Mr. Cooper. So those are some things to always look about in terms of market consolidation and where you're sitting in the seat, because your brokerage or company may be next consolidating or acquiring another company. Moving forward, another big local acquisition was Baird Warner acquired Dreamtown, two local companies, like-minded, very locally focused. They have staked the independence arm of their brokerage versus the national franchises. And then the last one is the huge one that was just announced in September this year, Compass acquiring the Anywhere Real Estate group of brands, which include Caldwell Banker, Century 21, Better Homes and Gardens. I mean, this is a big one. Robert Refkin, the CEO of Compass, says nothing is going to change with these brands. I am a little suspect of that. So keep your eyes open on what's happening once that gets through regulatory approval. But you brokers and agents out there, you may be on one side or the other of an acquisition. You are your own brand, and choose to work for the brokerage that works best for you and your clients.
Yeah,
Uh,
and Mark, coming out of the NAR settlement, have you has the way we do business changed? I mean, I know there's been changes to the contract. I know there's been the buyers commission discussions and all that. But what has been the impact for you, and what have you seen in the industry?
I would still say about 80% of the time the sellers are paying the buyers cooperating brokerage. But I
Hmm.
am seeing more and more full boat buyers are paying their realtors. But once again, it's, when we talked about this last time I was on your podcast, Steve, it's the 495 fee um, for both sides that, especially on the buy side, even if they've, I can't tell you how many times I've gotten a master statement the day before closing and I'm questioned about the 495 fee. I point the buyers back to their engagement letter with their agent that they signed, and then there's still bad feelings about it.
Hmm.
And I try not to throw any of the agents under the bus, but like, look, you signed this, maybe add a separate initial, maybe make it a separate document. I don't know what, because there are some sour grapes after a lot of these closings over a 495 fee that the agent doesn't even take a penny of it because it's
Hmm.
going to the brokerage. I think it's a money grab. I don't like it. And I've
Hmm.
always said that.
Okay. John, how about you?
I couldn't have said it better than as Mark said it. I see a lot of deals where the buyer is paying that 495 fee. There's some deals where the buyer is paying a portion of the commission. Sometimes the broker's justification is that it makes the offer, more viable. But I about 80%, give or take, is probably where I'm still seeing the seller paying the full commission. But a lot of deals, that 495 fee is in dispute, and sometimes it comes up in dispute, days leading up to the closing, and then the parties are arguing with one another about it. And it just depends on the circumstances of any given transaction, who ends up agreeing to pay for it. We've had deals where the seller side has agreed they're going to cover that, and then later they say, well, no, we're not going to do it anymore. Now do we jeopardize the whole deal for it?
Yeah. Yeah, and I think one of the big takeaways of this is, regardless of where the fee comes from, to gloss over it and hope they don't catch it when you're at that initial conversation is, that just, you could do all the best work throughout the whole transaction. The only thing they'll remember about it is that a stinking 495 fee. And so it behooves us to be able to have a professional conversation about everything that's a part of the contract, reminding them about it, and then, not panicking if it comes up again. And I believe the more the agent can take the ball on it and not kind of hide behind the attorney, the better the agent feels. If you feel good about the fees and if you feel good about charging them, don't shy back from it. So, okay,
Thanks
Matt.
for the insights. Moving forward, I'm just going to touch upon a couple things. NAR, which is the voice of real estate, the largest membership and/or trade association in the world, with currently about 1.5 million members. For good or for bad, they're the driving force of the real estate industry. They are the largest lobbying organization last year in terms of lobbying our federal government, heavily involved in state and local politics. You realtors out there, if you're not familiar with what's happening uh, on the national scale, there was a lot of turmoil over the last 2 years with NAR. There was a new CEO. Her name is Nikia Wright. She is really trying to transform the organization, clean it up. They've cut at least a third of their staff, maybe more, some major new hires this past year and trying to work their way back. One of the outcomes that we've seen is NAR's forecasting a lower number of realtors year over year. So this year they had about 1.5 million. Next year they're projecting 1.2 million. So just FYI on that. And on August 17th, we celebrated, if you will, the 1 year anniversary of the Sitzer-Burnett settlement, which transformed, or at least the goal was to transform with how the industry operated. And some of the positive outcomes is more transparency in the real estate transaction. You agents and brokers, you're doing a little more due diligence and working with sellers and also buyers with getting them to sign on the dotted line, exclusive agreements for both sides. From a consumer standpoint, that's good. The goal of this was to lower commissions, and every study that we have seen shows that most commission rates have gone up. And one of the reasons is consumers aren't balking at it. And I think you realtors out there are doing a great job of saying, here is what my worth is, and you guys should be paying it, and the consumers aren't balking at that. So kudos to you. I think it's kind of funny that the goal was to lower commissions and commissions are actually going up. And the last point post settlement was the large brokerage community was left out of the settlements. Many of them had to write huge checks to the government, and there's still a lot of bad blood that NAR is working through with the broker community. One thing I wanted to point out this past year, clear cooperation policy, which is the policy that states when a listing is signed, you have 24 hours to put it in the MLS. And the NAR came out with this delayed marketing and exempt listings, which sellers can instruct their agents to sort of put it on the private side and not put it in syndication for public use. That's a big thing that happened this year. The clear cooperation policy is the thorn in the side of Compass. Zillow, I didn't talk about the lawsuits that have transpired this year, but one of the big ones is between Compass and Zillow, as well as Compass and some local MLSs across the country, with how their private listing network is incongruent with this clear cooperation policy.
Marc and John, have you seen much do you see a lot of transactions, or is that part of your ecosystem? The private listing versus the clear cooperation and getting onto the MLS?
I hear a lot of murmurings when I present at different brokerages where they say, well, this brokerage is keeping things in the private, market. Maybe we should do as well. It's a very competitive market, and so I I think it does. I think it does happen. I personally think it's a disservice to the party that they're representing.
Hmm.
I think they should put it on the market and try to get their highest best. But again, there's sometimes there's controlling forces to suggest, hey, let's do it this way to try to keep it in house. And so I don't
Yeah,
know.
Mark,
Yeah.
anything on that?
So I actually just had a conversation with several agents about this, without naming names. Their goal is to have a vertical, everything in-house, lending, listing, so they get both sides of it. So I think that's the mandate
That's the play.
from the upper management saying, let's just keep everything in one vertical. I agree with John. I'm a Adam Smith guy, you know that. So I let the invisible hand do its work.
That's great.
All right.
So moving forward, one of the big changes that came out. So last month, NAR had their national convention, which includes their governance meetings. And what came out of this were some major MLS changes, first time in about 20 years. And some of the bullet points showcase that I put here is NAR removed 18 outdated MLS rules. And the biggest takeaway is NAR no longer having the control of the local MLSs, and the MLSs are going to take over and control a lot of the stuff that NAR used to mandate. Um, there used to be a national requirement to join the Realtor Association for MLS access, which created a lot of lawsuits, which are still in the court systems as we speak. And so one of the big takeaways is this is no longer a requirement. And then the last thing is this antitrust risk between the membership that is putting the burden on the local MLSs as opposed to NAR. And it's so NAR doesn't get as many lawsuits as they have been. I can't move my screen. Oh, no.
Well, I think the shift to the local MLSs is going to be, is going to stop some of the complaining from, and bring it more to a local level. And so I believe that as long, it's kind of like the dog that caught the car. Now what? The MLSs are going to catch their ability to control things. And I think for a lot of them that are run very well, Chicagoland has a bunch of great associations that really have strong opinions about the MLS and how it should be run. And I think it could be a healthy thing to take it from national to local. And but I think in some markets you're going to see some confusion and inability to get it right. Or now they're going to have to settle these arguments themselves instead of hiding behind the NAR.
Great. Are you able to see the next slide, Steve?
Yeah, we are. Now it's kind of a neat I like this. You're kind of uh you might not want to move over a little bit because your face is in the yeah,
Hmm.
there you go. If you move that way, whatever way you there you
Okay.
go. Yeah, okay, go ahead, Matt.
So this next slide is just a showcase for the audience out there. So the typical realtor, according to the 2025 NAR member profile, is a 57-year-old white female who typically practices residential real estate. So this 57 it's hovered between 55 and 60 for the last 10 years. Moving forward, just for the sake of time, I'm going to cover these 6 points, which is mortgage rates, affordability, inventory, jobs, economy, demographic trends, and then last, consumer confidence. So mortgage rates. So the Fed met for the last time of the year yesterday, and the current target rates for what we know as short-term overnight rates are now 3.5 to 3.75%. A lot of people think like, oh, when the Fed sets this rate, this should move the mortgage market. And that's not necessarily the case because the 10-year Treasury note is what's really impacting the industry. And so this is market driven. This is not due to the Fed. And so as of this morning, the 10-year Treasury rate is 4.11. It may be a little different now, but it's somewhere in that range. And typically mortgage rates ride, I'd say on average 2 percentage points above this, which would hold true. So when you see this 10-year Treasury rates, this is driving the mortgage market more than anything out there. And as of this morning, 30-year fixed rate, about 6.15 to 6.25, which is some of the lowest rates we've seen this year. 15-year is, I would say, on average 5.5%. And this graph is showing, which I always love, the 30-year mortgage rate over the past, 40 to 50 years. And I always look at that big spike in the early 80s, over 17%. And when you look at that, 6.2%, not too bad. Total existing home
Matt,
sale. Yes, Steve.
Matt, I just want to get Marc and John's opinion on this. Do you feel like, the market has been flat, and Matt's going to go through this right
Yeah.
now. Do you feel like rates are the main reason that the market is flat? Is that what your general perception is?
I I don't think rates were a couple years ago once all the stimulus was ended after COVID. Now it's just, I talk to all my agents, it's still inventory. I mean, now
Inventory.
that might just come out of their mouth because that's what's been coming out of their mouth for the last 3 years, but that's usually it's not rates any longer. Rate shock is
Okay.
over.
John, anything?
I think it is a combination of, again, not good the inventory that exists is not good inventory. You have inflation, you have uh, people's wages not necessarily keeping up with inflation. I think rates also do play into it. I think it's just it's like a perfect storm situation. And I would say things do appear to be pretty stagnant right now. People
Yeah,
still
and
people
go
still
ahead.
need housing, right? You got death, divorce, change of life circumstances, people move. So I don't
Yeah.
think that the need has changed, but people are having to decide whether or not they want to extend their financials further to try to afford a home. And there's a lot of people are saying, well, let me wait a little longer. Oh, I've got a current good mortgage rate. Let me wait, let me wait. And so I
Yeah.
personally think that again, over the course of time, I think there'll be more inventory, better inventory. I think people will get used to rates hovering between 5 to 7%, and then I think you're going to have a slow build.
Yeah. Okay.
Yep.
There's still a lot of folks in rate lock. I don't know if,
Yep. And we're going to cover
yeah,
some of those things
exactly.
coming up. So this slide, just moving forward, shows how flat the market has been. So literally over the last 3+ years, we have been in this just around 4 million existing home sales. And with the year that we're seeing here, it's going to shake out the same way on a national scale. Just some quick stats here in the Chicago metro area. For year-end 2023, closed sales was just over 89,000. 2024, closed sales 88,000. And the latest stats for Chicago metro area, we're tracking it's going to be almost identical year-end. Median sales price continues to go up incrementally. So if you go back to 2023, it was about 324,500, and we're almost at $370,000 at the end of October. Days on market has been pretty stagnant across the Chicago metro area. And then here's the latest stats, which is October of this year, just some high level stuff if anybody wanted to see it. It's sort of replicating what I just showed on the previous slide. And then moving forward on to some economic indicators. So US job openings have been pretty consistent this year, depending on the data source. I know the federal government with the shutdown, there's been some wonkiness in terms of job openings as well as labor statistics. But for what we're able to see, even from the private sector, job openings are still decent. Monthly job creation is essentially flat for this year. We'd like to see it higher, but not too bad. Unemployment rate, this chart shows a history I put from 2016 to the present time, so about 9 to 10 years. we have been pretty consistent and flat, and this has been, I think, the strongest point of the U.S. economy is the resiliency of our unemployment rate, which currently stands at 4.4%. And then just moving forward, I like to point this out. We have some great relationships with Landtrust, with the investor community, and real estate investors have sort of been this hidden gold mine in the marketplace. And some data points for you on the Zoom here and watching it after the fact is investors bought about 33% of single family homes in the second quarter of 2025. And investors own about 20% of our nation's 86 million single family homes. And a lot of people's perception is it's these mega corporations that own these thousands upon thousands of homes. And the reality is about 90% of these investment properties are owned, which are 10 or fewer properties, are owned by what we would call small time investors, mom and pop, single LLCs, et cetera.
Marc and John, we have a lot of attorneys on the line, and I know you guys deal with investors. And is it helpful to have a suite of services to support investors? I know there's a lot of other things that are needed, tenant issues, things like that. Maybe speak to just if you're working with investors, just the kind of the makeup of your firm and how it supports it.
I mean, every every real estate lawyer, is different. For our part, there's practice areas that we can handle. We do residential, we do commercial real estate. I do landlord tenant. And so, the prudent real estate attorney handling real estate transactional is going to try to look at the situation and basically either map it out or say, here's everything that we're expecting coming down the pipeline. If there's something that is coming that is at issue that we can handle, great. If it's not, it's something we're going to say you're going to need to get a zoning attorney or a tax attorney or whatever as part of that. And again, nobody's perfect. There might be things that come up during the process. You say, oh, now we got to deal with this new issue. So
Yes.
I think it's, and it's not just simply a plug for the brokers on to work with me or work with Marc, but you want to have attorneys who are keeping up to date on how the law changes and what the requirements are. You don't want your transaction to go off the rails, certainly not, close to the closing time. So I think it's important to stay informed as to what those requirements are and work with people who do the same.
Great. Marc, anything to add to that?
I concur with John. The biggest thing is since our firm is multi-dimensional, just like John's is be able to issue spot. You if you don't know any better, then it can bite you down the road. So we have multiple practice areas at our firm as well. One of the ones that, especially for my investors, that I tap into a lot is my relationship with the building department. I'm at the Daily Center, or I've got to be at 400 West Superior today. That tends to be because most of my investor clients are from different states. They're essentially REITs. They have a guy on the ground, and I'm at building court constantly because when we're selling properties, clearing things up, or when we're buying properties, it's part of our due diligence process. One thing we do for any file, regardless if it's an investor client or not, we pull a FOIA if it's a City of Chicago property because the Department of Buildings website is not 100% accurate. And I've made contacts at the 11th floor at the Daily Center and at 400 West Superior. So that is where our value add is to our investor clients.
Great. And whether it's forming an LLC, estate planning, whatever it is, if you're not able to do it as a firm, there's no need to get frustrated, but you got to have some partners that can fulfill those need areas so that you can provide the comprehensive service. So great. Thanks. Go ahead, Matt.
All right. So just moving forward, this slide and some key things I'm going to talk about here. So the profile of home buyers and sellers is probably my favorite research report that comes out annually from NAR. And for you attorneys out there, as well as brokers and agents, this is probably one of the best resources you could buy and access to get some insights into home buyers and sellers. And so I'm going to talk about some key insights that just dropped over the last month or so. And this is a big one, which is first-time home buyers dropped to their lowest historical level since data collection began back in 81. And that's now first-time buyers represented just 21% of the buyers for this 12-month period. So just a key data point here that first-time home buyers, it used to be as high as 50%. It's now down to 21%. And there's a lot of reasons for it we just talked about, and we're going to hit some of those as well. Moving forward, the age of the first-time home buyer is now the highest ever at 40 years old, which is unbelievable. And the age of repeat buyers, which is also the highest level ever, is 62 years old. So just to keep that in mind when you're working with clients and you get a 39-year-old first-time home buyer coming to the table, don't be surprised because that's what it's showing these days. And all cash buyers, which has been relatively high, it's an all-time high this year as well at 26% of the transactions out there. And home sellers now have owned their home for a median of 11 years, which is another all-time high. And I put in this because of lock-in effect. Years ago, it used to be 777, which means you buy your starter home, you live in it for 7 years, you trade up, you buy your next property, live in it for 7 years, and then you buy your final house. Those are no longer on the table. 11 years median length of time before selling the property, which is the all-time high. And this is just a little data point that I thought was fun. There's about 88 million homeowners out there, and there's 35.2 million without a mortgage, which means they own their home free and clear. So just FYI, there are many homeowners out there that don't have a mortgage. Do we want to stop anywhere for questions or commentary?
No, well, maybe I'll just pull Mark and John in on this in terms of you got this whole swath of younger folks that are they dismissing the value of real estate ownership, do you think, or are they have their mind on other things? What do you feel? What do you guys get a sense of out there?
I see a lot more deals cancel pre-inspection or on inspection with younger home buyers because if they're going to put their money into this kind of investment, if they got that far into it, they want to make sure it's a good condition property. And I mean, it's fine. They come back, they hire again, but if you, in terms of a trend, that's what I see.
Anything to add to that, Mark?
I've talked to a lot of people under 30, and they understand the power in home ownership, but they also like the flexibility. So they don't know how long they're going to be at their job, so why buy a house? So they would just rather rent, and other things like that. But there is a good section of people under 30 that I think that are still buying homes because some of them are my clients right now.
Great. Thank you.
All right, so what's on tap for 2026? This is probably what everybody wants to know. And so highlights from yesterday's Fed meeting for 2026, the Board of Governors, which was not in unified step. Not everybody was on the same page, but here's what they came out with. So they anticipate one rate cut for 2026. Obviously, that is to be determined, but what they're saying at year end is one more rate cut for calendar year 2026. Inflation will fall to 2.5%. This year, we've been running about 3%, and inflation has been a big topic point, affordability. But they're saying that inflation for 2026 will be 2.5%. They've recalibrated the gross domestic, GDP for next year to 2.3%, and the unemployment rate they foresee 4.4%, which would be the same as it is today. So I think a little better than anticipated. There's also, I know Jerome Powell, who will be leaving as the chairman of the Fed in, I believe, March or May of this year. He said that the Fed can't fix housing, the issues with housing. That was one of his takeaways yesterday, as well as the meeting before. And so everybody's got some predictions. NAR and Realtor.com, they had their economic forecasts this week. And so mortgage rate predictions for 30-year fixed, NAR says around 6%, Realtor.com saying 6.3%. You put my prediction, I'm saying it's going to be under 6% on average next year, which is more bullish than other people. And I'm saying between 5.5% to 6% for a variety of reasons. Number one, there's been tremendous pressure on the Fed from this current administration to change. And I know President Trump is trying to get his people on the board of directors, with Jerome Powell leaving. There will be a new Trump appointed person in that role. And I really do think there will be continued pressure as well as government interaction with the mortgage market as well as the rates. And then for existing home sales, NAR is predicting they're very bullish, 4.5 million next year. Realtor.com is a little more dovish, 4.13 million. I'm saying somewhere in between, just looking at the tea leaves, around 4.35 million, and this is US existing home sales. And then home price appreciation, NAR is once again bullish, saying prices will appreciate nationwide 4%, Realtor.com just over 2%. I'm saying it's a little bit less than that, just based on what we're seeing. And then last but not least, I want to cover just some insights and what I think may or may not happen next year. So government action, the government, there's a bill that's floating around right now that hasn't been, it was passed by the Senate, but it sort of died in the House right now, and it may gin up next year. But I think there will be government action to improve home ownership because of where we're at with it. I also believe that home sales will improve and increase. We have sort of dragged along the bottom the last 3 years, and I'm hoping that next year is the breakout year. Inventory is continuing to increase gradually. The lock-in effect of people who have, had these 3 to 3.5 to 4% mortgages is loosening. Delistings, which have been huge this year, will stabilize next year because people will understand the lock-in effect. If you need to move, you need to move. Inflation needs to go down, and I think it will. Higher costs are currently impacting, I think, a lot of home ownership actions. A point for everybody on the call, millennials and Gen Z are aging into their primary home buying years, which is good for everybody. And we're also in the middle of the greatest wealth transfer in our history, with generations passing along their assets to the next generation. Just be aware of that with your client base. I've seen it on a personal level with friends and family inheriting properties, and what do they do with that? And then last but not least, which is the psychological effect, I feel that if and when the 30-year mortgage rates dip below 6%, there will be a positive psychological impact on buyers, and there will be a lot of movement in the marketplace. Any questions or comments?
Nope, I think we're running on time, Matt. So let's.
So last but not least, here's some links. I love data, trends, information of the real estate industry. So Illinois Realtors, NAR, and Realtor.com have great research departments for you market stat junkies out there. And last, our little personal plug. Steve does a People Not Titles podcast, which I know many of you have seen. Part of the podcast network is our weekly Market Trends podcast, where Steve and I, if you enjoyed this presentation, we break down the latest news, trends, and information each week of what's happening locally and nationally.
Thank you.
And with
Thank
that,
you, Matt. So, Marc, I just want to say thank you very much for being a part of our panel, your commentary. John, thank you for taking the time out to give your insights as well. We'll have your information in the show notes as we send the follow-up to everybody. Bob, thank you for your presentation. And I just want to say thank you, everyone on the session today, for attending. And thank you very much. Hold on, we might have a question here. Oh, thank you. Very informative. Okay, great. That's kudos. So thank you very much. Thank you for your partnership with Landtrust, and have a great and blessed holiday. We just say we'll see you on the next presentation. Thank you.